The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, midweek trade on Wednesday, a little more green in the grains, and the cattle trade having a decent day as well. It feels like, though, some pretty significant resistance here, particularly in corn and soybeans post-December WASDE report, which had a couple surprises, particularly on the corn balance sheet. Let's talk about things. Joining us here on the program, pleased to welcome him back, Ted Seifert with Zaner Ag Hedge. Ted, it is good to talk with you again, buddy. How are you?
Doing great, Jesse. Always a pleasure to talk to you, man. Thanks for having me on.
You bet. You bet. All right, let's dive into this and your reaction to the December WASDE and some of the market reaction here the last session and a half, basically, here through Wednesday's trade. I feel like the corn numbers, there was some surprises, yet here we are struggling at 450, which is, a nice, big, friendly, round number. What's your thoughts post WASDE here in the corn market?
Well, Jesse, if you would have told me on Monday that the USDA was going to cut 200 million bushels off the carryover on a December WASDE report, which I believe is the largest downside reduction we've seen in a corn carryover ever on a December report. But if you'd have told me that on Monday, I'd say, wow, we might be up 20 or 25 cents. But we were up 7 1/4. Now, so I was a little disappointed with that, but I'm sitting there thinking like, okay, we've already rallied 14 cents off of Thursday's low. We had that reversal higher on Thursday, so I mean, maybe we were slightly overbought, and maybe if we had been sitting down at 428, maybe we would have gotten that 20 or 25 cent rally. I don't know, but man, I don't know. I was just kind of hoping for more out of that. 200 million bushels. That was a big reduction. When the trade wasn't looking for much, because we don't usually see much on a December report. So now what we're wrestling with, Jesse, is trying to figure out if the USDA, why did they do that on a December report, right? Was that a sort of, let's rip the Band-Aid off now and get the demand side of the equation kind of shored up before we come in and do the production, maybe small tweaks on the production in January? Or is this the USDA expressing a sense of urgency that, hey, we got to do something now because we're likely going to have to make more changes in the future, and we don't want to shock the market, right? We don't want to have to come in and do a 400 million bushel reduction in carryover, or 275 million bushel increase in exports, something like that. And I don't know, right? I'm really wrestling with that myself. What I will say is that, you look at what the outlook number was back in February at, 2.4 billion bushel corn carryover for this current marketing year, to where we are now at a 1.74 billion bushel corn carryover. I mean, they've cut 700 million bushels off that carryover number. So, I mean, the corn situation has gotten increasingly less bearish. Every report, every balance sheet, whether it's World Ag Board or USDA, every balance sheet that we've seen for this current crop has either been unchanged from the previous month or smaller ending stocks, right? And so less bearish, right? And so that makes you wonder, are the lows in for this current crop? And I'm going to say through July, the July contract. The September is a weird month, right? We never really know if it's going to act like an old crop or new crop. It's basically, we have to have a contract to bridge July and December corn. But I don't really include it with either one of those crops until we get to that time frame. And it's a cash contract, really, Jesse. But for the July corn, for example, I do wonder, are the lows in for the July corn contract, right? And anything before that, leading up to that. And I think the answer is probably yes, unless there is some major, black swan news event, China invades Taiwan, which is more of a soybean problem, as we all know, but that would affect markets as a whole. Or any other thing that we just don't have on the radar right now, right? And relations with Mexico, who knows? Short of something like that, right? I do get the feeling that we probably have the contract lows in. Now, does that mean we have to go sharply higher from where we're at? And I think something very interesting about the USDA report that we saw. They didn't change the average farm price for corn. They left it at 410.
Mm-hmm.
And I think that is their way of saying that if prices were to go sharply higher, they might have to actually come back in and cut some of that export demand, cut some of that ethanol demand, and push that ending stock back towards the 2 billion bushel mark. So I think, now being 50 cents off lows roughly, and I think we've done the legwork that corn needed to do to justify that 1.74 billion bushel carryover. To me, it's not an overwhelmingly bullish number. It is much less bearish than what we have been talking about. But is it a bullish number that says we need to see 5.25 corn? I don't know about that. I really don't know about that. Now you can get the funds involved and they can come in, or like I said in the scenario earlier where the USDA feels like they're going to have to cut another 250 million bushels eventually. Well, then that's a different story, Jesse. But if a 1.74 billion bushel if that's the smallest carryover we're going to see, or roughly give or take 100 million bushels, right? But I mean, anything from like a 6.5 to 7.4, somewhere in there. I don't know if that really justifies much higher prices. Now, seasonally, we do have this trend to go higher into that January report. Could I see March corn getting to 475? Sure. Yeah. That I think is a possibility, but I think it'd be like a slow grind higher. Corn, the way it's trading today, kind of to me acts like it might want to have a bit of a pullback, back and fill after 4 strong days higher, 5 strong days higher, or 4 strong days and a kind of medium day higher. So maybe there'll be a little bit of a back and fill, but yeah, I think it could go higher. I think a big question mark there though is what happens with the soybeans, right? And soybean price action, as you were saying, we're having a hard time getting up and staying above $10. The soybean balance sheet, yeah, they cut production in the November report. They didn't do anything on that report for December. The global numbers are pretty bearish. And they didn't raise the Brazilian crop, but I think everybody and their mom is raising their estimates on the Brazilian crop at this point. In my mind, that's probably closer to 174 rather than a 169. I think the USDA should have started with a higher number than a 169. And their weather's been pretty ideal, minus the first couple of weeks of planting where it was really dry, but that's changed in a hurry and the outlook looks really good for them. I think the second season corn crop is a different story. I mean, we're too far away from that to really make any assumptions anyways. But for the soybeans, I don't know. The global outlook is really rather bearish. And if beans can't really get a close above $10, and I think maybe by the end of the week, even Jesse, beans might want to lead the way lower. And that might be to the chagrin of the corn bulls, right? I mean, that might be a disappointment for corn. If beans break out to the downside, it might be an anchor on corn. So I think there's risk on both sides of the markets here. I think producers need to be looking at making some sales for new crop to the tune of 15 to 35% by the time we get to that January report. And again, if beans can't post a solid close over $10, it might have to be sooner than later. So I think, this time of year is a time where a lot of guys want to, just kind of walk away, lock the bins and just kind of, we'll think about it next calendar year. But I don't think it's a good year for that. I think there's a lot at play here. And really kind of triggered by the early harvest and the early harvest rally that we've had. Is everything been moved up a month and a half, right? Does that mean that we're potentially looking or getting close to highs here now, right? So, yeah, I think you really do need to pay attention here, at least for the next 2 weeks or so, and be ready to get a little bit more aggressive on some sales. And I'm not saying, sell all of 25, but I do think you want to get something on the books here before that Jan report.
Well, Ted, thinking about all this too, a couple thoughts I wanted to throw at you, and particularly leaning into soybeans here a little bit. I noticed that they cut the season average price for beans on the December WASDE. They didn't make a cut to corn. So I wonder, how much is this firing up the potential U.S. acreage conversation? I mean, you talk $10 beans versus $4 corn. From everyone I've ever talked to, you got a better chance of cutting a few things out of your corn crop and making, break it even, making money, whatever the case is at that price level for corn versus $10 beans. But I mean, what's your thoughts on that and this outlook going into next year, Ted?
Yeah. So, the reason why they lowered the bean price wasn't because of our domestic balance sheet. That's because of the global balance sheet, right? I mean, we've gone from just under 100 million metric tons of soybeans a couple of years ago from a global carryover standpoint to 135 million metric tons. And that number might actually be going up if that Brazilian crop is bigger, which again, I think is. Uh, so we are awash with beans, globally speaking. And we know that China in particular, but not just China, some other countries, global importers are going to prefer to do business with Brazil. Now, part of that's political and part of it is because of the currency advantage. So, we're kind of the odd man out to some extent on our exports. It certainly will be once that Brazilian crop comes online. So, the soybean outlook isn't great. It worries me. I do think there might be a window of opportunity for soybeans to rally in the next month, just based on, following corn, if corn's able to do it, and the fact that that Brazilian crop's not online yet. If we're going to do it, Jesse, I think that the chances now for soybeans, but the price action just, I don't know. It's not giving me warm and fuzzy feelings at the moment. But as far as an acreage mix is concerned, you look at the corn and bean ratio, and it does favor corn. Right. And so you think, okay, maybe that means we're going to lean a bit more heavily towards corn acres, which I think, that's what the market wants. That's what the market needs. That's why we have that corn bean ratio. And if you look at the global carryovers, you have corn at a 9-year low, basically, and you have beans, again, increasing, 40% basically in 2 years. So we absolutely need more corn acres and less bean acres. But here's the problem with that, Jesse. Input costs, right? I mean, yeah, to your point, historically, $4 corn versus $10 beans, we're going to be looking at probably more corn acres. But input costs are high, and yeah, you can look to make some cuts in some areas. But the thing that bothers me the most is interest rates, right? I mean, this is an environment that we've not really operated in. I mean, last year, yeah, but I mean, previous to that, we went through a very long period of time where interest rates weren't a thing, and they are now. And you just have to borrow quite a bit more money for corn than you do for soybeans. So I don't know. I wonder if we need to see corn do more than just the corn bean ratio. Do more, and by that I mean on flat price, right? Do we need to see December corn closer to 475? Is that what it's going to take to really get to? I think we need like 94 million acres of corn, maybe even more, right? So yeah, I that goes along with my thought of, I think there is a chance for corn to really, make some moves between now and the January report. I would like to see that happen, to be honest, Jesse. But it doesn't have to necessarily. I mean, it could be beans going to, closer to, 920, and then you really do say, okay, well, that corn bean ratio might do the work at this point. So yeah, I don't know. One other thing I'll say, just taking a bigger, broader perspective, right?
Mm-hmm.
We want to be friendly corn, right? We're in a demand-driven market, right? I mean, that 700 million bushel cut in domestic carryover that we talked about. Part of that was, the yield declining a little bit, or being a little bit under trend line. But for the most part, that's demand-driven, and we feel good about that. And we think, demand-driven markets can be sustainable. I mean, think about, the inflation and the demand markets that we had during COVID.
Yeah.
Inflation is bubbling back up a little bit. So we think, okay, hey, that could be kind of a good thing. But I also want to say, a lot of the purchases that we're seeing in corn from like Spain, for example, who's been buying, like gangbusters compared to what they normally do. A lot of this is I think global end users restocking the supplies that kind of dwindled during that peak of high demand that we had, end of 2019 all the way through 22, 23. And so I don't know if this demand-driven corn, lower bound. I don't know if that is going to be a lasting thing. I really get the feeling that they're using lower prices compared to where we've been for the last few years to restock those supplies. And once they're done with that, I do wonder if we kind of revert back to the mean.
Mhm.
And I'm being very careful with the idea of a longer term demand driven market. I really do think that we're heading into a down cycle for ags as a whole, led by soybeans. And so I think you need to use this time frame to really, take a very hard look at 25. I'm going to harp on that, right? Because I worry, even though I said that, I think maybe the lows are in for this current crop corn, everything through the July contract. I do think that if we don't have a major weather issue and we do get 94 million acres of corn, I think we solve this problem. And I think we will be talking about, a 2.2 billion bushel carryover in corn and, multiple years of down. And, everybody wants to get excited about, soybeans and sustainable aviation. But we've talked about that before, Jesse. I think ultimately that is going to be a great thing for soybeans in the U.S. I think that's going to be a good thing on a global scale, but it takes a lot of infrastructure to make that happen. And it is coming, but it's coming maybe not as fast as we want or need it to offset lower exports. And in order for that to continue to come online, we got to offer these big companies really, really nice profit margins in order for them to spend that infrastructure, spend that money on the infrastructure. And that means really good crush margins. And what that means is that we see low price beans compared to the products, beans and meal. And if we're crushing more for the oil for the first time ever, which oil stocks are historically low, right? I mean,
Mhm.
soybean oil is taking on a new role in that crush, which is great. But then we have a lot of meal, and that can hold back that crush margin. So I think it's just sort of an uncomfortable time frame for beans for a little while to get that demand actually built up. And long term, I think it's a really good thing for American agriculture. But I do also think that it leads us into a cycle of lower prices for both corn and beans over the next couple of years, short of a major weather catastrophe or some sort of what's the opposite of a black swan event, happening. I mean, there's a lot of things that could derail that idea. But I think all things remaining equal, that is my concern. So I do think we need to be looking at, further out in time, how we do things to stay sustainable, farming sustainably, with the positive balance sheets for the next couple of years. Because longer term, I do think there is a really nice light at the end of the tunnel. But I do think we have the potential for a down cycle here for a little bit.
Ted, good stuff as always. Just a couple minutes here. Final thoughts, anything livestock? You mentioned interest rates. I mean, macro markets, et cetera. I'll let you pick what avenue you want to go down, but anything final you want to share with us today?
Yeah, just real quick on the cattle complex. I mean, man, this time last week it looked like we wanted to fall into the abyss. I mean, we were standing on the edge of that cliff and we pulled it back, and that's really nice to see. I think we're more encouraged about domestic demand. We're less worried about this, economic recession into the winter months. Yeah, so I like what the cattle market has done. I still do think that upside might be fairly limited from here. So I do think that producers should be looking at some sort of protection to the downside, not necessarily being, aggressively short or anything like that, but some put protection, something like that. And in the meantime, the hogs are the ones that, I get the feeling the funds had been really using the hogs as sort of a recessionary hedge, with the idea that, hey, look, if times get tougher, people will be buying a lot more pork, cheaper pork compared to higher priced beef. And so hog prices could go higher. But I think they've kind of changed their tune on that. I'm a little worried about a deeper correction in the hogs market. And I think for the time frame, for just right now, the two might be inverse of each other. So there is that. And aside from that, man, overall economy with a change of administration coming, and I don't know. I think overall that you look at the stock market and things like that, it's warm and fuzzy feelings. I'm not 100% sold on that though, Jesse. I'm a little worried about what might happen for the first half of Trump's term. I think ultimately it is better for the economy. I think ultimately things
Mhm.
will be good, but it could be just like we talked about with the soybeans and transitioning to more domestic demand rather than export demand. Transition is a tough time frame. Can be hard, right? And that might not be a good thing for the overall economy. It might not be a good thing for commodities. I think we're gonna. I think there's a good possibility we go through a deflationary time frame, or where inflation really slows down. And again, that's not a bullish thing for commodities as a whole. So, yeah, again, I mean, I feel like we're in a much different climate than we were when we were, go back to COVID, when it was just stimulus check after stimulus check, and it was printing money and everything needed to go higher. Like, I just don't feel like we're in that climate anymore. And I think you have to have a different mindset.
Ted, if folks want to reach out to you at Zaner Ag Hedge and get some advice on their marketing, how could they reach you?
Yeah, you can call me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner.com, zaner.com. And you can sign up for our afternoon commentary. I do a recorded thing that's 5 to 7 minutes long. It's really mostly grains. Every once in a while, I'll do livestock. Yeah, so go ahead and do that. Other than that, I'm on the Twitter. I'm at the Ted Spread. Or X.
Ted's, yeah, Twitter, X Twitter, however we want to phrase that. You know how that goes. Ted Seifert, Zaner Ag Hedge, always good to hear from you, buddy. Thanks for joining us. Have a great week. We'll talk to you again soon.
Thanks, man. Appreciate it. Take care, Jesse. Talk to you soon.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.